CEO of the Women Presidents Organization. Thank you for joining us today for the webinar, Managing Your Finance and the PPP. With the recently released SBA forgiveness application, I'm sure you're all very eager to hear how to maximize your loan forgiveness. We have a lot of content today, so I want to jump right in. First, I would like to introduce CFOs to Go, a hybrid professional services firm consisting of both consulting and recruiting capabilities. They source financial professionals on a fractional, interim, and consulting basis and help companies recruit direct hire positions. CFOs to Go has extensive experience managing and advising companies through many economic shocks over the past 30 years and are poised to help many small businesses and startups navigate through the post-COVID-19 economic battlefield. With us today are three of CFOs to Go's CARES Act PPP team leaders. Chris Burns is a CFO partner leading CFOs to Go's startup and high growth practice. Jerry Johnson is a CFO partner leading their clean tech practice. And Tong Chin is a CFO partner leading their international practice and is a former deputy CFO, for the SBA. So with that, I'd like to introduce the team and send it over to Chris.
Great, Sheree. Great, Camille. Thanks so much and thanks everyone for joining us to talk about our thoughts on managing your company's finances in a post-COVID-19 economy. We believe that almost all businesses, are experiencing right now the biggest economic decline that the country's ever seen. Our U.S. economy is expected to contract by between 25 and 40% based on forecasts by investment banks and the Federal Reserve presidents. While revenue and cash inflows have dramatically decreased for most businesses that are slow to respond with significant expense cash burn reductions may run out of runway and find themselves needing additional capital much sooner than they originally planned. And outside the CARES Act loan programs, some of which we'll be talking about today, the terms are not going to be very pretty for getting that new financing. So cash preservation has never been so important. Howard Schultz, the former chairman and CEO of Starbucks, forecasted a few weeks ago that by his conservative estimates, millions of small businesses will not survive this pandemic economic fallout. We believe businesses need to come up with a battle plan blueprint to come out the other side of this. So this slide has a subset of our recommendations for small businesses and large businesses to employ to significantly reduce their cash burn. Most businesses' largest fixed cost is their payroll. So while the PPP program that we're highlighting today will help with some short-term relief to help retain employees, we believe all businesses should be considering significant headcount adjustments, either temporary or permanent. Also, cutting all discretionary spending is paramount, and if you haven't done so already, we recommend eliminating or deferring all discretionary spending for 6 months or longer. Many companies have already experienced some significant savings through cutting travel, conferences, in-person learning, and many other expenses. But even after the recovery, we expect that many businesses will actually traverse to a remote working environment so that they can continue to achieve those savings on an ongoing basis. So we recommend also moving to rolling 12 or 13-week cash flow forecasting so that you have a clear understanding of what cash is going to be coming in, what cash is going out. Your CFO or controller should be immediately working on improving their working capital efficiency by negotiating with both your vendors and your customers. Finally, if you do not have sufficient financial management bandwidth or financial experience in your business, we recommend that you engage outside advisors, financial consulting, outside advisors, to help put your business's battle plan blueprint in place. We have consultants that do that for many clients, but you probably already have financial advisors as well to help you out. Please do engage them now. So today we're highlighting what clients should do on the forgiveness portion of their PPP program. my partner, Jerry Johnson, will take it from here.
Thanks, Chris. Welcome to everyone. Wanted to just first say that while the PPP program we think is a very useful program for a lot of businesses, and I know for many of you that have already applied and received the funds, or trying to make the best of it, but clearly the biggest benefit is going to be being able to maximize the amount that you can get forgiven. And we feel that with the way the banks have been trying to deal with this, I mean, you think about it, the SBA loans that have been coming out of this are orders of magnitude greater than what any banks have had to deal with before in a very short amount of time. They've really not been equipped. They've done their best, but at the same time, they've not been equipped to necessarily be able to handle the onslaught. And I'm sure many of you that were working with the banks found that they either were not ready at the very beginning back in early April, or the processes were evolving. And so it's very important that, right now that you get help to be able to work with that, because we feel that with the forgiveness process, it's likely to be the same sort of thing where the guidance from the SBA has been slow in coming. In fact, it was just the first form that came out this past Friday that provides some indication of exactly how the forgiveness will be calculated. And it's very important to be able to get help to do that, because ultimately you want to be able to be focusing on running your business and not trying to worry about maximizing the forgiveness. And we've been putting together a team to be able to work on that and been focusing on this forgiveness process now that many of our clients have been able to receive the funds. And really what it comes down to is kind of looking at organizing records and being able to make sure that you are clear on what is going to be forgiven. Because while the loans were sized based on payroll, it's obvious that the forgiveness is going to be calculated on more than that. It's payroll costs as they were previously defined in the application process, but it's also including things like business rent or mortgage interest if you own your facility, as well as utilities, which can include things like internet and even transportation, although that has yet to be well defined as to exactly what gets included in that. The current rules right now are that it's going to be for the 8 weeks from the date of funding. That's when the 8-week process starts, and you're to be capturing the costs that are to be running during that period of time. Also, one of the rules is that 75% or more of the proceeds from the PPP loan have to be applied to payroll costs and not to these other costs that can otherwise be part of the forgiveness process. Now, even though you've gotten, the loans were designed to be forgiven at least as much as possible, but to the extent that payroll has changed either by headcount or by reductions in the amount that you're paying your employees, that can also impact the what you can get forgiven. There's a couple of different ways that they can measure the timeline that you're using as a baseline to compare your current headcount during this 8-week period. It can either be for the first 2 months of the year, or it could be from February of last year through June 30 of last year. The applicant, the borrower, gets to choose which one of those is more favorable. Obviously, we want to get the lower one. So what you're comparing to current headcount now, you can then be able to make sure that that doesn't provide a reduction for it. At the same time, you have, if you have a reduction in the amount that you're paying people, and if it's over 25%, then that also can be used as a reduction against what you're going to be able to get forgiven. Although the amount of that 25% only applies to people that are getting paid on an annualized basis, $100,000 or less. If you're doing reductions for people greater than that, then that reduction doesn't count against the forgiveness. As far as the reports required, I mean, you're going to have to provide things like payroll reports, also documentation on the invoices for all the different benefits, rent and other utility expenses you're going to have. So it's important to be able to try and organize those records up front to be able to make sure that you do that. And so if we go to the next slide, you'll see that the tracking this, it really makes sense to make sure that you've got all your records in one place. We recommend that you set up in your accounting system a means by which to track these expenses, because while the amount of loan is non-taxable to you, the current rulings and guidance are that the expenses related to those forgiven amounts will not be able to be used as a business expense for tax purposes at the end of the year. So not only for the forgiveness process right now, but also when you're doing your taxes for 2020, you want to make sure that you've got your records in place and be able to account for that, because it'll be much easier to kind of plan things, kind of begin with the end in mind, being able to plan, have your records organized such a way that you can use it not only for the forgiveness process, but also for their tax records at the end of the year, rather than having to try and scramble and untangle things later on. Now for payroll amounts, many of the larger and even some of the mid-size payroll providers have been organizing different types of reports and record keeping elements to be able to track these things for the forgiveness. So it'd be worthwhile to talk to them if you don't already have information from them on what those reports are, because then that will just make the whole forgiveness calculation process much easier. And remember that, in terms of calculating what payroll can be forgiven, it's only amounts up to $100,000 per employee, which when you do the math from 100,000 divided by 52 weeks times 8 weeks is $15,385 per person. So that's the maximum amount per person for payroll, the actual gross wages that you can get. Now, you still get to include the benefits and related local taxes on top of that. So the $15,385 is only for the gross wage part, and then those other pieces get added on. Again, it's worthwhile to know what you're working towards. So you want to make sure you're organizing your records to the extent that you can do that in your system and be able to code that properly, and also for any documentation that you're going to need in terms of invoices paid and the like. You want to make sure that you've got maybe separate folders or means by which to scan that and have that already, so that when you're getting ready to go through the process to working with the bank for the forgiveness, because again, although you've applied for the loan and forgiveness is available, you have to actually make an application to the bank to get it forgiven. And each bank will probably have a slightly different process, because right now, although there's general guidelines, as you probably found when you did the application process, the banks themselves find different ways to try and streamline it in their own thing, because they're dealing with potentially thousands of applicants and they need to be able to figure out a way to do that. So they may have their own tools or methodologies to do that. So it's worthwhile to engage with the bank early on in the process, really from the time that you receive the funds. They may or may not have it all worked out, but it's good to have an open dialogue with your client representative to be able to understand what the process is, get the information as soon as possible, and work towards being able to do that. For many of the banks, they may only have a limited period of time that they're going to be able to allow you to apply for forgiveness. So it's important to be able to have your records in place, be able to do that, to make sure that you can do that straight away. And for that, we'll now pass it on to Tong to talk about other elements in the CARES Act.
Tong, you're muted.
Sorry about it. In just 15 minutes, I'm sure you have learned a lot about the PPP loan forgiveness from my partner, Chris, and Jerry's wonderful presentation. I would like to use this opportunity to briefly mention various other programs available to small and medium-sized businesses. First, there's the economic injury disaster loan. If you already applied for this loan and got a confirmation number from the SBA, you should expect an email from the SBA for further information. However, if you have not applied, the SBA is now only accepting applications from the agriculture businesses. This may change as new funds may come in, but for now, they're only working with ag businesses. Note that the PPP loan is applied through SBA identified banks. The SBA disaster loan is directly applied through the SBA, and it is can be used for working capital. So it is very different than the PPP loan, since 75% of the PPP loan must be used for payroll purpose. However, the disaster loan doesn't have the forgiveness feature. So the maximum loan term is 30 years. The interest rate is about 3.75%. You may have both the PPP loan and the disaster loan. However, You cannot use two loans for the same needs. This principle actually applies to all the government provided benefits. It is very important that you don't use different funds for the same purpose. It's just you don't duplicate your benefits that you receive from the government. In addition to PPP and the disaster loan, there are also other programs. We have listed some of the major ones on this slide. The SBA debt relief program applies to borrowers that have the SBA 7A 504 or microloans. If you're not familiar with the SBA 7A 504 and microloan programs, please refer to my earlier blog on the CFOs to Go website. The various SBA loan programs support small businesses that cannot get a loan through conventional financing. I would like to emphasize, if you took the PPP loan, then you cannot take the employee retention credits. Then there's also what we call the 5-year carryback on NOL. For tax years 2019 and 2020, businesses can utilize NOL net of losses generated in prior years to offset 100% of taxable income. And then there's also the Main Street Lending Program. I noticed some of your WPO members are probably larger businesses if you under the definition of the SBA. So for those businesses, if you are not qualified to get the PPP loan, there's a called Main Street Lending Program. It's a loan facility constructed by the Federal Reserve that will allow small and medium market firms to obtain bridge financing due to COVID-19 crisis. The bridge financing term is pretty short. It's only 2 to 4 years. And the feature of this loan programs is the loan has a minimum size. So the loan has to be $500,000. So that's the size limit. So your monthly payment is pretty high since the term is 2 to 4 years, the loan size is bigger. This loan is also guaranteed by the government. However, the Main Street Lending Program doesn't have the forgiveness feature. So you have to pay back on the Main Street Lending Program. There are other tax credits and tax deferral available for small businesses. Because we only have a limited amount of time, I'm not going to talk about all of them. Should I apply for the employee retention credit instead of the PPP loan? Should I bring my employees now back from unemployment? What other loans available? For example, short-term loans. I know we have given you a lot of information and you will hear more information from the later presentation. I'm sure you're overwhelmed. I am. Even I've been working in this area for more than 20 years. Please talk to your CFO and your other executive teams to prepare a financial plan for the next 12 months. The next 12 months is very important. Getting a loan or getting forgiveness of the loan is just the beginning in fighting the economic downturn. To survive and thrive, you need to have a 2-year financial plan. You may need to get additional capital, talk to your bankers, tax accountants, and other advisors you may have worked with. If you don't already have one, our team at the CFOs to Go is ready to support you on every step of your businesses. Now my partner, Chris, will wrap it up. Chris?
Great, thanks, Tong. Thanks, Tong. So CFOs to Go pivoted quickly to develop expertise and tools to meet the immediate opportunities and challenges that were created by the CARES Act stimulus programs. So our team's response was urgent. We developed expertise at a phenomenal speed, and we secured dozens of PPP and EID loans for our clients. So we pivoted again after that first round of funding began to build a forgiveness project team and practice offering. So we have actually developed a focused practice with some technology applications that we built internally to help clients build a very bulletproof, audit-ready support package for their banks. As Jerry suggested, the banks that we know have struggled in the first round, many of them have hired auditors for this forgiveness project because they just know that the job ahead of them is going to be very difficult. So we recommend that you put together a very strong audit-ready support package for your bank. And with that, I'm going to turn it back over to Camille.
Thank you so much. So much great information there. Appreciate all of your time, Chris, Jerry, and Tong. Really valuable. And I think we already have some questions coming in. So when we have time at the end, I think there's people looking for additional information. And now I would like to introduce our speakers from Foley & Lardner. Foley & Lardner is one of the 50 largest law firms in the nation, with nearly 1,100 attorneys in 24 offices throughout the US and across the globe. Foley organized multidisciplinary and multi-jurisdictional task force to address the wide range of legal and business challenges that companies face in responding to the coronavirus outbreak. Foley has created a Coronavirus Resource Center, which offers insights to provide timely perspective on what companies can do now and how they can prepare for the future. You can find it at foley.com/coronavirus. So to introduce our speakers, Casey Fleming is a partner at Foley & Lardner LLP, where she focuses her practice on executive compensation and employee benefits. Ms. Fleming's work includes advising private and public employers on the issues that affect retirement plans, health and welfare benefit plans, non-qualified deferred compensation plans, executive compensation and severance arrangements, and employment agreements. Casey is also one of the firm's go-to resources with respect to the forgiveness of the Payroll Protection Program loans under the CARES Act. Cherie Rady is a partner at Foley & Lardner LLP, where she focuses her practice on commercial lending, finance, loan workouts and restructuring, real estate leases and lease workouts, and business transactions. Cherie is a key member of the firm's Coronavirus Task Force on PPP loans under the CARES Act. And Cherie is also a longtime WPO member. So with that, I will turn it over to Casey and Cherie.
Great, thank you so much, Camille. And thank you all for attending today. I echo the prior presenters' feelings about how overwhelming this can be. And as they pointed out, it's overwhelming for us as well. So with that, I'm going to hit you with a lot more information. Before I dive into the slides, I want to give you a heads up that there is a lot of information on our slides. We included a lot of detail so that when they're provided to you, you can use them as a reference source going forward. But what I'm going to focus most of my time on today is highlighting some of the questions that we get most often from clients and some of the additional information that we gleaned from the SBA application, which was published last Friday. So with that, a quick disclaimer, I'll let you read that yourselves. And just to highlight, I really do need a haircut. Okay, so as we've been talking about, the key to this PPP program and what makes it unique as opposed to most other lending options is this concept of forgiveness. So this first slide walks you through what is potentially forgivable. Some of the prior speakers touched on this already, but as a quick reminder, up to 25% of the amount that you submit for forgiveness can be used on what we call non-payroll eligible costs. And we reviewed for you earlier what those are: mortgage interest, rents and leases, and utilities. And then at least 75% of the amount that you apply for forgiveness must be used on payroll costs. I think it was Jerry who mentioned that while the original CARES Act guidance in the statutory language does say that all of those expenses must be paid and incurred during the 8-week period that starts on the disbursement date, the SBA application did clarify for us that employers may opt to use an optional covered period for purposes of payroll costs only. And that optional period, they're calling it the alternate payroll covered period. And what that allows you to do is, rather than counting your payroll costs on the date of disbursement, which may have fallen in the middle of a payroll period for your company, they're giving you the opportunity to start counting those costs towards your forgiveness application, beginning with the first day of the first payroll period, beginning after that disbursement date. For the most part, we believe that this is a rule for administrative convenience so that you don't find yourselves wanting to run additional payrolls or going through too many proration formulas. Another one of the big clarifications with respect to payroll costs that was shared in the SBA application was how we're thinking about those costs that can be forgiven. And what I mean by that is, is it cost incurred or accrued? Or is it costs that are actually just paid during that forgiveness period? And the SBA did provide a lot of helpful information in their application. And to simplify it a bit, essentially all of the payroll costs and eligible costs that are paid during the applicable covered period that you're using will be eligible for forgiveness. In addition, anything that's incurred or accrued or earned during the applicable covered period is also eligible for forgiveness if, in the case of payroll costs, it's actually paid by the first day of the next payroll cycle, or in the case of the other rent utilities, the non-payroll costs, that it's paid before or by the next billing cycle. So that should also help in terms of administration. Some less critical but also helpful clarifications is that you cannot prepay mortgage. That is a question we got from a lot of our clients. The interest, mortgage interest and rent obligations apply to leases on real or personal property, so that's helpful as well. I'm not going to go into a detail of this slide, but it's just a reminder in terms of what can be counted as payroll costs for your employees. Quickly, I'm going to jump into some of the reductions that can be applied with respect to your forgiveness eligible amount. So as a reminder, essentially what employers are going to do, borrowers are going to do, is they're going to take what I call all these expenses and throw it into their forgiveness bucket. And then that's the maximum amount that you can have forgiven. And then those amounts can be potentially reduced based on these reductions. The first relates to that 75-25 split I referred to earlier. And there is an example in here to show how that reduction will work. And essentially what the SBA or your lender will do is they will take the amount that you are applying for forgiveness and confirm that not more than 25% is being used on non-payroll costs. If it is, they will just reduce the amount that is forgiven with respect to those non-payroll costs in a manner to get that ratio back where it's supposed to be. The salary and wage reduction, at a very high level, essentially what the SBA is doing here is making sure that you haven't taken all of your workforce and essentially applied a significant salary and wage reduction from Q1 2020 until your relevant covered period that you're using. And for this purpose, they did provide a lot of additional clarification, because essentially what they're allowing you to do is to use an average rate of pay, which was not at all clear in the statute, which left a lot of really big open questions. So that's the big point here. If this is going to apply to you or your organization, I would highly advise that you consult with someone like CFOs to Go, Foley and Lardner, or any of your existing advisors, because the calculation can be a little bit tricky. And finally, the last reduction is a headcount reduction. So the SBA is essentially saying, nope, you can't reduce compensation significantly if you want to get full forgiveness. And we also don't want you reducing your headcount, because the point of this loan is to keep your workforce employed and paid at about the same rate that they were being paid before. The big clarification that was provided in this space is how to calculate full-time equivalent employees. Because what you are doing is comparing the full-time equivalent employees during your covered period to those during one of the other 2 periods that are mentioned there, February 15th, 2019 to June 30th, 2019, or January and February of this year. And for that purpose, you're supposed to use a 40-hour work week or an equivalency method, which lets you count 1 for a full-time person who's working 40 hours or more, and 0.5 for someone who's working less than 40 hours. So I know that was a lot of information, and there's even more information on the slides that you're probably reading. We're happy to answer any questions, but in order to allow Q&A time, I'm going to pass it on to my partner, Cherie.
Yes, hi, I'm Cherie Rady, and I'm a finance partner at Foley & Lardner. I'm a member of WPO LA Downtown and Platinum 3, so shout out to WPO. Today what I'm going to cover would be some of the newer items, things that you might know about, or safe harbors and updates from the SBA. So the first one I'd like to cover is safe harbor on good faith and certification of necessity on loans under 2 million, which is commonly referred to as FAQ number 46. So the question came up is, how will the SBA review borrowers' required good faith certification concerning the necessity of their loan request? And what's happened is we're having a lot of questions come up about necessity, and necessity, which is a certification, and that certification reads as follows, that when submitting a PPP application, the borrower must certify in good faith that current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. And that certification is signed either by the CFO or the CEO owner, and there are civil penalties that attach if there is not a good faith certification, and even criminal penalties. So many companies that did obtain the PPP loan were looking at it, and the question was, do you have an outside access or source of capital? So that would be lines of credit that are available, that would be bank loans, that would be sources of capital from parent companies. So it just became somewhat difficult and confusing to answer. And so thank goodness the SBA has now clarified that by saying that they have created a safe harbor, and that this safe harbor is that any borrower that received a PPP loan less than $2 million will be deemed to have made the required certification concerning necessity of the loan request in good faith. So the good faith safe harbor for under 2 million is very welcome. The reason the SBA did that is because they have determined that this safe harbor is appropriate because borrowers with loans below the threshold of 2 million are generally less likely to have had access to adequate sources of liquidity in the current economic environment than borrowers that obtained larger loans. And then what they will do is they will use their resources to review the larger loans, and they feel that this is a good approach for all. So anyway, this was a very welcome safe harbor for many of our PPP loan borrowers. Next is that the borrower is a borrower-friendly implementation of statutory exemptions from the loan forgiveness reduction based on rehiring of employees by June 30th. So just telling you that in passing. There's also an addition of a new exemption from the loan forgiveness, I think Casey touched on it, for borrowers who have made a good faith written offer to rehire workers that was declined. This is commonly known as FAQ number 40. I'd like to go into it a little bit more because this has come up quite a bit at Foley. So we've had questions come up where the employer would like to rehire the employee. They make the offer to the employee and say, can you come back? And the employee says, well, I'm actually making more money on unemployment. My hourly rate is better with unemployment than if I go back to work. Or, just sometimes there's reasons they can't come back. I mean, not related to that. But basically, the employer then says, you know, what am I to do? So here's the question that the SBA put, and here's the answer on that. Will a borrower's PPP loan forgiveness amount, the loan forgiveness amount, be reduced? And that's the operative word, be reduced, if the borrower laid off an employee, then offered to rehire the employee, and the employee declined the offer to return to work? And the answer to that is no. The SBA says that the borrower must have offered to rehire the employee at the same salary, wages, and same number of hours. And if it is a good faith written offer of rehire and the employee's rejection of that rehire offer is documented, then there will not be a reduction. So that is a very welcome update as well. And that, again, that's FAQ number 40. Next has to do with what payroll costs cover. I saw Casey had a slide on it, which detailed a number of items. I'm going to refer to FAQ number 8, and which is, do PPP loans cover paid sick leave? And the answer is yes. PPP loans cover payroll costs, including costs for employee vacation, parental, family, medical, and sick leave. However, they do exclude any family leave wages for which a credit is allowed under the Families First Coronavirus Response Act. So that is, again, another welcome update. The last thing I'd like to cover quickly is a potpourri of questions that we've been answering at Foley, and we've been asked numerous times, so I thought maybe you would like to hear some of these questions. It may be some of yours already. First is, has to do with PEOs, or professional employer organizations that process payroll. And so the question has become, what if I contract with a third-party payer? Are the employees eligible, and may I take them as a deduction? And the answer is that the SBA recognizes that eligible borrowers that use PEOs or similar payroll providers are required under some state laws to report wages and other data on EIN or PEO of the payroll provider. However, the payroll provider has provided these amounts to the employer. They can be used for the PPP loan payroll documentation. However, the SBA does not want any double dipping. So if the employer is taking those employees, they don't want also the PEO to take those employees as well, which I think, makes a lot of sense. Next question that's come up is about independent contractors. Should payments that the borrower makes to independent contractors or sole proprietors be included in calculations of the eligible borrower's payroll costs? And the answer is no. However, the sole proprietor or the independent contractor are themselves eligible for a loan under PPP if they satisfy the other applicable requirements. So anyway, these are some of the commonly asked question potpourri. We at Foley are happy to help you. As you can see, there's a lot of nuances, and I guess I'd say the devil's in the details. It can become very complicated just to answer a simple question. So anyway, at this time, I want to leave time for questions, so I'd like to turn it over to our moderator.
Thank you so much, Casey and Cherie. Again, a lot of great information. And now I'm going to pass it over to Kirsten Wynn, who is going to moderate the Q&A portion.
Okay, so the questions are coming in on the chat, and I'm going to go ahead and ask the first one. Can the PPP funds be transferred to new owners if business is sold before the 8-week period is up? Whoever wants to jump in.
I'm happy to speak to that. The short answer is yes, it can. How that happens depends on the form of the transaction. So if you're selling your business in a stock transaction form where you're selling all the equity interests to another buyer, then that obligation or grant, however you look at it, would transfer along with all of the other interests associated with that corporate entity. If you are selling your company in the form of an asset transaction, that can be a more complicated question. The CFO to go folks, I'm sure, can comment more robustly on this, but it's my understanding that for the most part, at least until the loans are actually forgiven, they're listed as liabilities on your balance sheet, and then they will transfer over to the income category. So you just have to make sure that in connection with the business negotiations, if you want that PPP obligation to be transfers, that it's contemplated in the purchase agreement where they cover, you know, transferred assets or excluded assets and liabilities.
I'll just also chime in that I would agree with that, and I would say that, yeah, for the asset sale, you would have to make sure that that is specifically called out in the documents as to where that falls as far as an asset being part of the transfer. Otherwise, it would remain with the person that first received it, and they would have to then sort out exactly how that would be processed.
Okay, great. The second question is from Jennifer. The $15,385 max is problematic for 2 employees since it is counting weeks rather than months, which is how our payroll runs to calculate an annual income. Is there any other way to run this differently to make it work for an annual under $100,000?
I'll take that. Unfortunately, many employers are going to have challenges because their payroll periods do not coincide. If they do not have weekly payroll or payroll every 2 weeks, then there's going to have to be a proration of the payroll for the covered period or alternative covered period that the borrower chooses. And unfortunately, the rules are pretty clear that each employee is capped, at least for their gross compensation, at that $15,385. However, as Jerry suggested, those highly paid employees are eligible. The medical benefits that the company pays on their behalf, as well as other costs that are in the payroll cost formula, can be added for those individuals that are making more than $100,000.
I would also add to that, as far as the way that the calculation was done, because it was done 2.5 times the monthly payroll costs, that there's, as we've gone through it, the idea of being able to get 100% forgiveness is going to be a challenge, because if payroll costs have to be 75%, but you're only using 8 weeks versus 2 months, you may find that the math just doesn't quite work unless the other costs that relate to payroll costs are enough that you can basically get to kind of pick up that last stub period, the remainder of that to be able to get to the 75%, and then the remainder can be covered by the non-payroll costs.
Yeah, I agree completely with everything they said. The only thing I would add is remember to think about this practically. That's just a cap on the amount that you can have forgiven with respect to those employees. That does not mean that you cannot pay your employees more than that. So when you're thinking about filling out the actual application, you're just going to list an amount of money, and if you've hit that $100,000 on an annualized basis, you're going to put that $15,000 and something dollar amount in, and then just make sure that you have those payroll records for up to 6 years to back up that calculation.
So following that trend, here's another one from Donna. Can you bonus employees for extra work during the 8 weeks above their salary and include that in your forgiveness as long as salary is under 100K?
Yeah, I think we believe that that's a tricky question, right? Because the intent of the SBA was to include in the forgiveness portion only those expenses that were incurred during the period. Now, there may be some employers that opportunistically pay bonuses or other forms of compensation over and above the typical salary. And we think that as long as that additional compensation was incurred and earned during the covered period, that it should be okay. However, there could be some banks and the auditors for those banks that help them that may challenge that assumption if those bonuses were not done in the ordinary course of business, such that, you know, if they looked back to prior the prior year period and there were no bonuses, and then all of a sudden there were bonuses in this 8-week period, that would appear to the SBA potentially to be opportunistically trying to take advantage of increasing their forgiveness.
I think one thing that I would add on to that would be that for those companies that are, especially if you have a retail or other organization where you're paying your workers to be able to work longer hours and not just overtime, but you're doing bonuses for basically almost like hazard pay, as some of the companies have been kind of describing as. I think that could be an argument you can make that would say in those instances, they would be applicable, incurred during the time based on the conditions on the ground at the time, and those would be likely to be eligible.
Agreed.
So there's an add-on to this one. Can you run an extra payroll with the small balance remaining so you hit the 75%?
That would not be incurred. I mean, I think really the idea is that if you've got somebody that's got a base pay of say $80,000 and you're paying them so much every 2 weeks, to try and run an extra payroll would not necessarily be then covering actual work being done during that time, but would in fact be a prepay, and that would not be something that would be eligible for the forgiveness.
And I think the key here is the difference between accelerating salary. So say your covered period ends on June 20th. You should not be prepaying July salary. Completely agree. We don't think that that would be allowed. But if you want to run a special payroll the last day of forgiveness period to cover amounts that were earned during the covered period, that's fine. And that's actually what a lot of employers thought they might have to do. But because of the SBA's new guidance saying that as long as that amount is paid during the next payroll period or before the next payroll period, that can still be counted, which will help alleviate the need to run that special payroll.
There's another way to make up that small gap between the 8 weeks and the 2 months as well. And that is if you ended up having more employees in place that were earning payroll, or if those employees received a raise after the baseline period, so they're now making more, which many employers went through an annual raise process earlier in the year, that it's possible to make up, that the employers might make up a portion of that gap anyway, just naturally, if they went through a salary raise increase or hired more employees.
Okay, the next one is from N. Cooper. The PPP loan forgiveness application states that your forgiveness won't be reduced if you have a written decline of FTE from an employee. It also states that your loan will be forgiven if you restore full employment by June 30th. Is it safe to assume that if you have restored employment for everyone except people who declined in writing, that will be accepted for full forgiveness?
Yes, that's hopefully how it should work. So you compare June 30 to your average employment FTEs on February 15th. And as long as you restored by that date, we're hoping that the offer of employment will essentially just be an add back to those numbers, and that's how it will work. Cherie didn't mention it, and I forgot to mention it also, but the SBA also clarified that there are a number of other, whether you look at it as an exception or an add back, and they're huge. They are firing people for cause. So if anyone's fired for cause, they don't have to count against your calculations. People who voluntarily resign, or people who voluntarily request a reduction in hours from the employer. Of course, you should keep records of all of that so that it's clear that all of those things were in fact voluntary, but it can be a huge help.
Yes, I'd like to, hi, this is Cherie. I'd like to add that one of the issues too is that, none of this is completely 100% certain, but we feel that if you follow the rules and, as we've discussed, that it optimizes your ability to collect 100% of your PPP loan. And, who knows what the SBA may, what nuances might come up, but basically we feel that this would be the appropriate way to go forward.
Okay, the next one. Is Congress working on extending the 8-week forgiveness period? Do we have any flexibility in extending that period if it makes better sense for my business to spend it over a longer period of time?
Well, there's been a lot of articles, and it seems like there's various groups, both professional as well as business groups, that have been pushing for changes. And I know there's even some pushback that when you think about like the 75% for payroll costs, that was not in the original legislation. That was something that the SBA imposed as kind of their view of the intent. Congress may or may not agree with that. And so I think it's a fluid situation right now. I mean, as we saw in the original PPP application thing, there were literally 9 or 10 different IFRs, or interim final rules, which itself seems like kind of an oxymoron to be interim and final, that were amending and adjusting the actual original legislation and interpretation thereof. And I think you'll find that with the forgiveness part, while we just got this past Friday the first template of how to be able to fill out the forgiveness thing, there's likely to be more clarification from the SBA and potentially some additional clarification through legislation from Congress. So it's fluid right now, and it's likely to evolve over the next couple of months.
Yeah, there is a lot of pushback, obviously, from employers that were, because they weren't essential businesses, or just because the business slowed down so much that they had to reduce significantly their headcount. They applied for the PPP loan, they received the funding, and yet they're not ready, either their state or just the state of their business. It's not ready to come back online and take advantage of the forgiveness opportunities. So there's a lot of pressure right now being applied. And just as with the original loan application period, where we were receiving new guidance every 2 days, both the Foley team and our group, I'm sure, were overwhelmed ourselves as we described that we could likely see that kind of clarification and continual guidance updates as we go.
I'm going to give some tough love, and this goes back to my crystal ball comment. As everyone has said, some of this has been crazy, and the SBA has said things that nobody expected. But I would not plan right now for an extension of the 8-week forgiveness period. The SBA loan forgiveness application has come out, and while some additional clarifications may be made, I think it is highly unlikely that that particular period will be extended. So I would, at least for purposes of your business planning, count that as the final period. The one thing to remember is that this is a loan. So we're talking a lot about forgiveness, but you can keep using the funds for a certain period, and that's actually an open issue right now. So while the use of the funds is still restricted, the 8-week period doesn't end when you can keep using the funds. It's just that those funds would then be rolled into your note, and that note has really favorable terms. So I tell people, don't put the forgiveness horse, before the cart. And so the world is not over if everything doesn't get forgiven.
Great. All right, the next one from Andrea Keating. If you have to furlough employees after your PPP period ends, and you do so after June 30th, will the payroll during the 8 weeks still be forgiven?
Yes, I mean, that's the current interpretation, that as long as you basically are maintaining payroll for the 8 weeks from the funding date, or that next payroll period starting the 8 weeks after that, the intent is, and really by design, this was all basically geared towards the idea that 8 weeks would be enough to kind of get through the worst of it. That remains to be seen. But that if for some reason, the business doesn't come back after 8 weeks, and I would really kind of steer clear of the June 30 date, because for some people, if they got their funding in May, say May 10th and something like that, then your 8 weeks runs into past June 30th. So I would really look at the 8-week period from the funding date to say when your kind of period that you have to be maintaining payroll if you want to maximize forgiveness. But after that 8-week period runs, if business conditions change and you have to lay off people, that shouldn't affect your amount to be forgiven.
And as Casey pointed out, which I think is a tremendous point, and our partner Tom is reminding us all the time about it, that this is a very low cost source of capital, and getting wrapped up around the axle on the forgiveness piece might be more than some businesses need to worry about. A lot of businesses need that capital when they are ready to restart. And so again, forgiveness won't be impacted with the actions that are taken down the road, but you will have capital should you not be fully forgiven to help address your capital needs down the road.
Just to remind everyone, okay.
Sorry. So just so you know, the capital is very tight now with all the lenders. So if you need additional capital, it's the time you don't focus on the forgiveness, because if your business had to shut down after June 30, you may want to keep the money so your business can keep running for another year. So for a lot of small business, those are the tough decisions they have to make. But I just want to let you know the capital market's very tight now for you to get additional funding with any lenders. So this loan is 1% interest rate and have deferment, so you can use this money to keep your door open. And any other programs now, if you may need additional funding for the next 12 months, so that's something you really want to consider instead of only focus on the forgiveness part.
Okay, the next one is from Alicia. Alicia, you might need to jump in to clarify here, but here's what it says. With reference to FTE count, if we hire new employees as net new employees, not replacing currently laid off people, for example, hiring more field techs than previously needed, or hiring sales people with different experience or expertise than others that might be currently laid off.
I can start this one. So we think that the answer is that this will be fine, and the form of the SBA application supports that. There was a lot of confusion around this because the FTE count reduction referred to rehires, which in many people's minds references people who are essentially hired to replace people who are laid off or furloughed, which is I think what you mean, as opposed to shifting the focus of your employment base and putting them somewhere else. At this point, it looks like it's a straight mathematical calculation. I'm interested to hear what everyone else thinks.
I heard presentation from one bank that they are not matching the names. So I think if you have new hires, it's fine as long as you kept the number of employees, or you may be expanding because of various reasons. So those all fine, can be counted as part of the forgiveness package.
Okay. I'm going to do 3 more here. So this one is, are retirement plan contributions included in payroll costs?
Yes.
Yes, so
Yes.
employer contributions that are both earned and incurred and also paid, if not during the period, immediately after the covered period would be included. However, many employers typically choose to do 401k match or 403b match or stock program contributions at the end of the year, and they're a discretionary match program. In those cases, if the payment did not occur until the end of the year, then the contributions by the employer would not count towards forgiveness. You can't do it just based on an accrual basis.
And I think we haven't weighed in on this, but I think there are some open issues. I've read some publications to employers who have not yet made their employer contributions with respect to their 2019 plan years, because you have until your tax filing or extended tax filing deadline technically to make those contributions to your trust. Whether or not those count, I think it's aggressive, to Chris's point, because those amounts were not incurred or earned during the covered period or 2020 whatsoever. But there are I think some strategies that you can use. Employers do have flexibility in terms of when they fund their employer contributions. In most cases, you can amend your plan to change that date. So if you're struggling to make your 75% threshold, you should call your advisors to talk about some flexible options there.
Okay, next one is, I heard previously that any employee working 30 hours or more was considered an FTE. Please confirm this is not true, and employees working 30 hours per week are now considered a 0.5 FTE.
That's correct. Before there was guidance from the SBA, some advisors were saying that we should refer to the Affordable Care Act standard, which uses 30-hour per week, if the SBA wasn't going to come out with guidance. The SBA has come out with guidance, so that's correct. If you're going to use the equivalency method, then for both periods, so your covered period and whatever period you choose to compare that to, someone working 30 hours per week would be a 0.5. If you decide to use the standard method, then that person would be a 0.75, or I think that's correct, because you're around a 10th.
Okay, and last question. I have commissioned employees who are not making their normal variable comp because of our reduction in sales as a result of COVID. Can I bonus them too?
That's similar to the question that we answered earlier. And if it is in good faith, I believe a payment of compensation to the employee for that period, then I believe, this is just personal, I believe it would count towards forgiveness, as long as it wasn't, as I suggested earlier, an opportunistic way to get your payments to your employees either sooner than you otherwise would have, or you're paying them now for a prior period, then I think it would be applicable and forgivable.
Okay, thank you. For any of those who asked questions and didn't get them answered, we will relay them to the presenters with your email just so that they can get in contact. And back to you, Camille.
Thank you so much, Kirsten. And I really want to thank all of you. This was really an incredible program. I'm sure that everybody who was with us today got a lot out of this, and really appreciate your time, during which I know is a very, very busy time in your world. So thanks, everyone. I'm glad everyone was able to join us today, and be on the lookout for our upcoming webinars. An email, I think, will go out tomorrow. So thank you, everyone. Have a wonderful day.